Good afternoon and welcome everyone to this External Reporting Board webinar on the recently published standard which introduces enhanced disclosure requirements concerning the fees a reporting entity or group pays its audit firm. For the auditor review of the financial statements, we're kind of used to that, the financial statement audit fees, and any other fees that an entity pays to its auditor review firm, such as fees you may pay for valuation services or tax services or other types of insurance engagements or agreed upon procedure engagements. There's lots of different types of services your audit firm may be providing to you in addition to the annual or interim financial statement audit. We have continued to hear feedback, quite strong feedback from readers of the financial statements around the importance of these disclosures and having an understanding of the other services and the nature of those other services that you're paying or organisations are paying to their audit firms in addition to the financial statement audit. This has all been seen as and continue to be seen as a disclosure of high interest and high importance. Hence, we started a project to look at the current disclosure requirements, and we definitely found a need to enhance them, and that's what we've done by issuing this new amending standard. We also appreciate that the disclosure of this type of information comes with sensitivities, because the provision of other services by an audit firm comes with or is seen as potential threat to auditor independence. So there is sensitivity around this type of disclosure, but that sensitivity only again to us and to the feedback we've received from readers and users highlights the importance of this disclosure. But we are also conscious that for many types of these other services that an audit firm may be providing to their audit clients, there are good reasons and synergies that arise from providing those other services and many benefits that come with that, because your auditor, I was an auditor for 14 years, so I'm a little bit biased, but your auditor knows your organisation better than many others through the audit process and through looking at your internal controls. So it does make sense to use your audit firm to provide other services in particular circumstances. And that might be for other types of insurance engagements or compliance regulations that require someone independent to look at other types of information. So it does make sense. It's not always bad that an audit firm is providing other types of services. Definitely not. So we're being very careful to balance both the user needs and interest in this information and also the sensitivities that come around it, and to make sure always that there's a clear and consistent picture being provided. That's what this is all about, is providing consistency and disclosure, about providing transparency and disclosure. Cool. So those opening comments, just some quick housekeeping. And that is, and it's always the first question we receive, is that this webinar is being recorded and will be available to all participants and anyone else shortly after this live session. It will go on as a YouTube video, so that will be available. And also we'll distribute the slides to all participants, so that will be sent out afterwards. So that's first piece of housekeeping. Second is Q&A. We love the Q&A, and Q&A often highlights things that either we've covered too quickly or we're not quite making sense. So please, you feel free to use the Q&A function that you can see at the bottom of your screen. I'm going to stop talking very shortly, and so I'll monitor the Q&A, and we'll come back to questions at the end and bring forward some of the questions that will be of benefit for everyone to hear. So we are focused on trying to allow for 10 minutes at the end. But there is a bit of detail to work through, so we'll keep working through that. Cool. So with that, an overview of what's coming ahead. Introductory comments from me, just a little bit more. Then we are very pleased today to be joined by Jaakko Moisen from the FMA, just to provide some more context around the importance of these disclosures. So we'll hear from Jaakko very shortly. And then we'll hear from Gali, the expert, who's going to walk through exactly what these new enhanced disclosures are and going through the different categories. Cool. So we'll move on to next slide. Cool. So some quick comments from me that these amending standards are applicable to both for-profit entities and public benefit entities. Public benefit entities including public sector and not-for-profit entities for both for-profit and PBE Tier 1 and Tier 2. So we're talking about those larger organisations that have got statutory reporting requirements. So a standard for each sector, but the requirements are substantially, if not just about exactly, the same. Cool. We'll move. Already talked about what the requirements are doing, enhanced disclosures. There are already disclosures around audit fees, but we're adding more and making them better, again, around transparency and consistency, that people are doing different things. We have had, and we do have, very useful guidance from FMA on this, and some of the amendments is catching up with that and bringing those guidance material into the accounting standards. Gali at the end will talk about when the amendments come in, but they will be mandatory from accounting periods commencing on or after 1 January 2024. So a little bit of time, but then as Gali will talk about at the end, there are comparatives required, which means you do need to start gathering this information sooner, but you should have this information now. It's just about how you go about disclosing it. Cool, we'll move on. This slide here, and this is what Gali will be walking us through, is just highlighting this is the core requirements of the amending standard. This is it. This is what's required from a note disclosure perspective. And then when you pick up the amending standard for the first time, there's a number of additional pages. And that's recognizing, as you start to glance your eyes over these core requirements, there are lots of terms that are used in audit and assurance standards, lots of different things that when you dig into the detail, that more questions arise. So we have provided additional guidance around what all these things mean. We've provided additional guidance around examples, so you get a good understanding of what we're expecting in these different categories of other non-audit services, which Gali will talk about shortly. Just highlighting these are the core requirements. This is it. Cool, we'll move on. Why were they introduced? So I'll just click through. I'm going to cover this pretty quickly because I've covered it off. But it's really, if you look at the left, is the current requirements, and it's all about the B. New Zealand has had a long history of disclosing audit fees in financial statements. And it is interesting, these are all domestic requirements. This is not required by IFRS standards. Other countries may require it through regulations, but New Zealand's a little bit different. But we've got a long history and it's always been seen as highly important. Every time I used to be an auditor and I'd go to an AGM, quite often the only question I get is about the audit fee disclosure. It seemed to be all they're interested in. And it's like, did you miss the fact the company made a huge loss? It was no, they're interested in the audit fee. So there's always an high interest disclosure, but it's about the B, other services, and we've enhanced that B to introduce specific categories around explaining those other services an audit firm may provide to an entity that it's also auditing. Just noting briefly, Australia have got a project on this, and they've been following extremely closely what we've been doing in New Zealand. We decided a couple of years back that we couldn't wait for Australia, because generally we like to have things harmonised, that this disclosure was so important that we needed to move ahead. But Australia have got a similar project. They are looking extremely closely at what we've done in New Zealand, but they will go through their own consultation process that may result in consistent requirements, or it may end up with different requirements. It just depends what they hear from their constituents. But in principle, I would say with a fair amount of confidence that they will issue, they will have the same requirements in principle in the future. Maybe some changes around the edges, depending where they end up. Cool, thanks, Carly. We had a consultation, we had lots of feedback. So this has gone through full exposure draft process that many of you will already be aware of. The main messages here is that what we've come up with in the final standard was strongly supported through all feedback received. We got some questions around the edges. We got some questions around, can you provide additional guidance? Can you provide additional examples to make this as easy as possible to put these other types of fees into specified categories? And that's what we've done. That has resulted in a few more pages in the amending standard, but there was a desire for this to be as clear as possible. There's always going to be an element of judgment in anything with accounting, but we've looked to reduce that as much as possible. But we can never move judgment completely under a principles-based approach, which we do take in New Zealand around accounting standards. Cool. So that's enough on that, Gali. Okay, so before we hand across to Gali for overview of the amendments and getting into a bit of the detail, wanted to hand across to Jaco from FMA and for his opening comments on the importance and what he's heard around these disclosures.
Thank you, Anthony, for the introduction and the opportunity to touch on the important topic of independence and, of course, the transparency of that in financial statements. The purpose of an audit is to enhance the degree of confidence users have in a set of financial statements. And the role of an auditor is to provide independent view or whether the financial statements prepared in all material respect in accordance with that financial framework, depending on what framework it is. If users of financial statements believe that the auditor did not appear to be independent, that might have an impact on the confidence that they have in that set of financial statements, probably the overall trust in that auditor and audit firm, and maybe in the trust of the audit profession as a whole. Although, of course, directors should be fully across the independence of their auditors and the assurance providers, it is kind of a bit more difficult for investors to get sufficient insight to assess if they are comfortable with the services provided by their auditor, and if that kind of might have an impact or not on if they have been seen to be independent. Currently, investors must look at various disclosures in annual reports, financial statements, and the audit opinion to get that complete picture. The new requirements in FRS 44 provide the readers with financials with better insights in those services provided by auditors that could negatively impact the independence. The clarification of the type of services is, I think, beneficial for investors to compare disclosures more easily, and also maybe ask some further questions or clarifications if needed during an AGM. The changes in the disclosures, together with the new requirements for auditors when it comes to the services that they are able to provide, will probably reduce some of that disclosures going forward, because the new auditing standards prohibit more and more services to be provided by the auditor. As a regulator, we continue to focus on independence of auditors, and we use those disclosures in the financial statements to assess the risk of potential independent breaches. The new requirements will therefore be very helpful for us as part of our work, but we might also ask, for example, entities, some questions about the disclosures in the financial statements, and if there are any omissions, we might ask them to clarify that as well, or maybe even restate that. So we thank the XRB for the work on this. As Anthony mentioned, New Zealand is in a good position as the disclosures are transparent and are in the financial statements. A lot of overseas jurisdictions don't have the same requirements, and therefore investors don't get the same type of information about the services auditors provide. I think if looking into the future as well, we might have to consider that we don't only disclose the audit fees from the financial statement auditors, but maybe also the fees of other assurance providers, especially where they are required by law. For example, the new climate-related disclosures, you might need to have a assurance provider for that as well. Currently, that's not covered by this disclosure if they are not the auditor of that entity. These types of insurance engagements getting more importance in the future. They will likely be expanding, and that's therefore something that entities might want to consider as well to provide some disclosures on that. Thank you again for the XRB's work on this, and handing it back over to Gali.
Thank you very much for this, Jaco, and thanks, Anthony, and kia ora, and hello, everyone. I'm going to give you a quick overview of the enhanced disclosure requirements in the amending standards on disclosure fees for audit firm services. So just for context, the objective of the disclosures is to provide information that will assist users of financial statements to assess the extent to which non-audit services have been provided by the entity's audit or review firm. So with that in mind, in summary, the amendments require reporting entities to disclose the fees incurred during the reporting period for services received from the audit or review firm using specified categories. So firstly, there continues to be a requirement to disclose the fee for the audit or review of the financial statements, or if you're in a public benefit entity space, then the audit or review of the financial report. What is new is that if the audit or review firm provides the reporting entity with other services in addition to the audit or review of the financial statements, then entities are required to disclose these fees for those non-audit and non-review services using specified categories. And these categories are audit or review related services, other assurance services, and other agreed upon procedures and engagements, taxation services, and other services. For each type of service classified in these categories, entities would need to disclose a description of the type of service and the total fee incurred for that type of service. And I'll explain each of those categories in more detail in a few minutes. There are some disclosure concessions for Tier 2 entities. So entities reporting in Tier 2 don't have to use the specified categories for the non-audit services that are shown in blue on the slide, but they still need to disclose the total fee for the audit or review of their financial statements and the total fees for all non-audit and non-review services provided by the audit or review firm. And also they need to provide a general description of these services. And we'll talk about Tier 2 a bit later in the webinar. I will note here that we are using a lot of terms, specific terms in this webinar: audit firm, audit or review engagement, assurance services, agreed upon procedures, etc. We are not going to explain all of these terms today, but they are explained in the amending standard in a way that is aligned with the relevant assurance standards and other standards issued by the New Zealand Auditing and Assurance Standards Board. So if you're not familiar with a certain term that we're using today, and if we haven't explained it, I encourage you to have a look at the amending standard, and the answer should be there. Also, before I move on, one question that we often get asked is, do these amending standards change what services my auditor or the audit firm of my financial statements can or can't provide to me as the reporting entity? And the answer to that is no. So these amending standards are accounting standards. So they don't tell auditors which services they can or can't provide to their audit clients, but they do require reporting entities to disclose information about the services that have been provided by their audit or review firm. Of course, auditors would be following professional and ethical standards when determining whether they can provide a particular service to an audit client. And there are some restrictions in professional and ethical standards about certain types of services that audit firms can provide to their audit clients. But this aspect is not covered in the amending standard that we are discussing today. So now let's go through each of the specified categories of fees for services provided by the audit or review firms. So firstly, let's look at the fee for the audit or review of the financial statements or the financial report. This category includes the fees for the audit engagement or review engagement over the general purpose financial statements. So it includes the fees for the audit or review of the annual financial statements or financial report. And it also includes the fee for the audit or review of any interim financial statements for those reporting entities that issue, say, a half-year interim report or quarter-year interim financial statements and get an audit or review, an audit opinion or review conclusion over those interim accounts. And just a reminder that for public benefit entities, the fees for the audit review of the financial report would include the audit review of the service performance information, which is part of the general purpose financial reports prepared under PB standards. And now let's move on to the categories of non-audit and non-review services, starting with auditor review related services. So auditor review related services include those services that are closely related to the work performed as part of the financial statements audit or review engagement, but which are not required to complete the audit or review engagement. And or it includes services where it is reasonable to expect the service to be carried out by the entity's financial statements auditor or reviewer. So this category includes those services that are largely carried out by members of the financial statements audit or review and engagement team, where the work generated relies on synergies of knowledge gained from undertaking the financial statements audit or review engagement. This category can also include services which are required by legislation or regulations to be performed by a suitably qualified auditor or assurance practitioner when the service meets the description of this category here. So as you can probably tell, this is a nature-based category, so to speak. So in other words, whether a service is classified in this category depends on the nature of the service rather than the type of the service. So this category can include assurance services, but it can also include non-assurance services like agreed upon procedures engagements, provided that the nature of these services is consistent with the description of this category. So in other words, to be classified in this category, the services have to be closely related to the financial statements auditor review, and or it must be reasonable to expect the financial statements auditor or reviewer to carry out the services. So because classification into this category is based on the nature of the service, in some cases, judgment would be required. For example, when you're trying to decide whether an assurance engagement or an agreed upon procedure engagement should be classified as audit or review related services, or perhaps as other assurance services and other agreed upon procedures engagements, which is the category I'm going to talk about next. And it is possible that different reporting entities might make different classification decisions about certain types of services. But this is mitigated by the fact that the amending standards require disclosures or require entities to describe each type of service within each of the categories. So as long as you disclose the description of each service within each category, then users of the financial statements should have enough information, enough clarity and transparency for the purpose of their assessment of non-audit services provided by the audit firm. And these are some examples that could be classified as audit or review related services. These are included in the standard just to give extra guidance to help apply the requirements. So we've talked about the nature of services that could be classified as audit or review related services. And now let's look at the actual disclosure requirements. So for each type of service classified as audit or review related services, you would need to disclose the nature of the type of service and the total fee for that type of service. And you'd also need to specify for each type of service whether it is an assurance engagement, an agreed upon procedures engagement, or another type of non-assurance engagement. So now we're moving on to the next category of non-audit services, which is other assurance services and other agreed upon procedures engagements, which just to save space on the slides, we've abbreviated as AUP from here onwards. So the category of other assurance services and other agreed upon procedures engagements, as the name may suggest, it includes any assurance services and any agreed upon procedures engagements that have not been classified as an audit or review within audit or review related services, and also which are not part of the audit or review of the financial statements. So as I mentioned before, these terms are defined: assurance services, agreed upon procedures, engagements. These are defined in the standard. Just at a very high level, without getting into detail, in an assurance engagement, if the audit firm provides an assurance engagement, that they would provide some sort of conclusion, whereas an agreed upon procedures engagement, the audit firm would not be providing an opinion or an assurance conclusion, but rather they would carry out specific procedures which might have been requested by the regulator or shareholders or grant providers, and the audit firm would report the findings of those procedures, around those procedures. The easiest way, I would say, to find out if a certain service is an assurance engagement or an agreed upon procedures engagement is to have a look at the engagement letter from the audit firm. So in summary, any assurance service and any agreed upon procedure engagement that did not meet the description of audit or review related services, and of course, which is not part of the audit or review of the financial statements, would go into this category: other assurance services and other agreed upon procedures engagements. And there are some examples here of services that could be classified in that category, like for example, an agreed upon procedure relating to health and safety. So yeah, quite different to the audit or review of the financial statement, not closely related, etc. In terms of the disclosure requirements for this category, they're quite similar to the ones for audit or review related services. So for each type of service, the entity needs to describe the nature of the service and disclose the fees incurred. And also for each type of service, it's necessary to specify whether it's an assurance engagement or an agreed upon procedures engagement. And now we're moving on to the third category of non-audit services, which is taxation services. And this category includes services relating to ascertaining the entity's tax liabilities or entitlements, or satisfying other obligations under taxation law. But this category excludes the review of tax balances or disclosures that are actually part of the audit or review of the financial statements. So very often your audit team would involve the tax team from the same firm to review the tax balances that are presented in the financial statement or the disclosures relating to tax for the purpose of the audit. So that service would not be in this category of taxation services. That is part of the audit or review of the financial statements. So there are some examples here of types of taxation services that would be classified in this category. And just a caveat here that for some of these examples, there may be restrictions in professional and ethical standards, which are applied by auditors regarding which types of services the auditor can or can't provide to the audit client in certain circumstances. So again, the amending standards don't say which services the auditor can or can't provide. They just require disclosures about the services that have been provided. But as far as I know, there are some restrictions around taxation related services and professional and ethical standards. And then the disclosure requirements are again similar: disclose the nature of each type of service and the total fee for each type of service classified in that category. And now moving on to the last non-audit services category, which is other services. So again, as the name probably suggests, this category includes all other services provided by the audit or review firm that have not been classified in any of the categories that I just went through. And here are some examples. So we've got accounting and bookkeeping services, administration, legal services, due diligence, etc. And again, for some of these examples, there would be restrictions on whether and when audit firms can provide these services to audit firms. And these restrictions would be in the professional and ethical services that auditors apply. The disclosures that are required for each type of service is, again, to describe the nature of each type of service and disclose the total fee for each type of service. And we have used the term type of service a lot. So just noting that, for example, the examples that are listed on this slide, that would be, that's what we're sort of talking about when we are saying types of services. So say for your other services category, you would have a line for each of those types of services that are mentioned in the gray box here. And this is an illustrative example. So it's based on an illustrative example we've included to accompany the amending standard. It's showing what the disclosure could look like. It doesn't have to look exactly like this, but yeah, this is just to provide you some guidance on what it could look like. So I won't go through that in detail. You can have a look in the standard, but this example assumes that the auditor review firm did not provide any taxation services or anything in the other services category. So we have the auditor review of the financial statements, we have auditor review related services, and we have some assurance engagements, some agreed upon procedures engagements there. We have other assurance services and other agreed upon procedures engagements, and we do have, again, some assurance services, some agreed upon procedures. And then we have the totals for each type of service and the overall total. So that's just an example. And yes, tier 2 disclosure concessions. So as I mentioned at the start, for both for-profit entities and public benefit entities in tier 2, there are some reduced disclosures when it comes to the new amending standards. Tier 2 entities need to disclose the fees incurred during the period for the audit or review of the financial statements, and the total fees for services other than the audit or review of the financial statements that have been provided by the audit or review firm, with a general description of these non-audit services. So in other words, tier 2 entities are not required to break down the fees for non-audit services provided by the audit firm into those 4 specified non-audit categories that I just mentioned. It's useful to remember, I think, that before these amendments were issued, tier 2 entities were not required by accounting standards to provide disclosures about fees paid to audit firms. So there were existing requirements about fees paid to audit firms, but tier 2 entities had disclosure concessions from all of these requirements. So the amending standards do introduce new disclosure requirements for tier 2 entities, but these disclosure requirements for these tier 2 disclosure requirements are reduced as compared to the more detailed requirements for entities in tier 1. And the reason for the reduced disclosures for tier 2 is just to take into account the balance of the costs for tier 2, for preparers of financial statements in tier 2 versus the benefits for the users of tier 2 entities' financial statements. And finally, when are these amending standards going to be mandatory, which is, I believe, a question that people often are interested in. So the amending standards are mandatory for periods beginning on or after 1 January 2024. So the first cabs of the rank, so to speak, would be entities with 31 December 2024 year ends, and then the 31 March 2025 year ends, 30 June 2025, etc. If you want to apply the amending standards early, technically you can start applying them for periods that end after the standard takes effect for legal purposes, which is after the 15th of June 2023. Having said that, accounting standards set minimum disclosure requirements. So if you want to provide additional information about fees incurred for services provided by audit firms earlier than the date, then you can do that. It's additional disclosures you are allowed to add them in. What I should mention is that comparative information is required. So you would need to show the prior period figures with respect to the disclosure requirements in the amending standards. And yeah, but just to reiterate that the mandatory date for applying the standards is periods beginning on or after 1 January 2024. So thank you very much. That was all about the overview of the disclosure requirements. And now I'll hand over to Anthony for some questions and answers.
Yep. Thanks, Carly. You've done extremely well with the time. So we've got about 7-8 minutes available for any questions. They have not been flooding through the Q&A, which just means, Carly, you'll be making complete sense. But does anyone have any questions they'd like to drop through either the Q&A or in the chat? So I think at a high level, the standards make sense and the disclosure expectations, but there will be some questions around the edges, especially for those preparing group financial statements, and when you've got an auditor, a different auditor involved in subsidiary entities, there will be some questions around that where you need to work through the detail of the standard. So I've seen a couple of questions come through, so I'm just going to read them live and then we'll see if we can answer them or not. This is in reference to an auditing standard. ISA 700 requires inclusion of a statement as to the existence of relationships which the auditor has in the entity. However, it does not prescribe the period covered. Can you please provide commentary around FRS 44 and how ISA 700 should interact? Are you expecting these relationships in the audit opinion? Okay, so this was discussed during the development of the accounting standard and recognising the different requirements between what is required to be disclosed by the auditor in the audit report versus what's required to be disclosed in the financial statements. And yes, the comment is right that in the audit opinion, the auditor is required to disclose any relationship it has with the entity. We are totally supportive of that requirement, and we felt it was appropriate for that to be disclosed in the audit opinion, and that it did not need to also be disclosed in the financial statements. Probably what I would say, speaking out loud, is that idea of a relationship between the auditor and its client could be broader than what is required by these disclosures in financial statements around other fees for other types of services. But that will be a requirement for the auditor to consider that, and to also to continue to make sure they provide appropriate disclosure around that in the audit opinion. I wasn't sure, Jaco, if you had any observations around that type of disclosure around audit relationships in the audit opinions.
Yeah, maybe one more comment, Anthony, because there is no exact match between the two disclosures, because of course the audit is done till about 3 or 4 months after the financial reporting period. So if there are any services provided in that period, they should be disclosed in the audit opinion. And of course, there's no requirement to have that in your financial statements because they don't relate to that specific financial year. So yeah, there can be some differences between the two disclosures, but that should be just those kind of period after year end.
Yeah, that question was leaking through a bit into timing of what gets disclosed, and again, the New Zealand Accounting Standards Board considered that. We had some responders saying, should fees incurred after the reporting period, but before the financial statements are approved, so after balance date, should that type of thing be disclosed. Mainly for simplicity, we took the view that this fee disclosure should be the fees expensed in that reporting period. If there is any other significant fees incurred after the balance date, after balance date events, that would get caught by other standards which require disclosures around significant after balance date events. But definitely the time period of these disclosures, which Garley has just talked about, is for the accounting period and being the fees that have been expensed through the profit and loss for that period. So just looking at some other questions. Question around RDR. And RDR, as Garley mentioned, is that at the moment, these full disclosure exemptions from current requirements, it came as a little bit of surprise to me that there's no requirement for Tier 2s to disclose their audit fees. Under these amendments, we've changed that. We've introduced a new requirement for Tier 2 to disclose their financial statement audit fees. And then there's one more line as a total, any other fees that has been paid to the audit firm for any other types of services, and then a requirement to provide a general description. So we are adding additional requirements for Tier 2, but we have had feedback that is extremely important to provide at least some form of minimum disclosures for Tier 2 entities. Cool. So another one, which I'm going to read out loud, and we'll see if I can answer it. The disclosure of tax services, what is the guidance on the split between tax balances prepared for audit versus tax balances revisited for tax return, as the work will be under different disclosure section requirements? I'm a bit worried about this word prepared. Tax balances prepared for audit. I would still say, off the top of my head, reacting at the moment, that tax balances prepared, focusing on that word prepared, would be falling under taxation services. You wouldn't put that under the financial statement audit category, because the only type of tax services you provide under the financial statement fee is the review of tax balances for audit purposes only. So that word prepared, at least for me, throws it into taxation services category. But did you have any views on that, Garley, or you?
I suppose, I guess, to just something that we've also mentioned during the slide is that if we're talking about preparation, that's a different story. But if the question was referring to the audit, the audit team checking with the tax team of the same firm about the tax balances, the tax disclosures, that would be for the purpose of the audit of the financial statements. So that would be, in my understanding, part of the audit or review of the financial statements. So it would be in that category, and then, yeah, tax return preparation is listed as an example that could be included under taxation services, and tax calculation to prepare accounting entries is also listed as an example of taxation services. So if that helps.
Yeah, that does help. I think it's that distinction between preparation and checking for audit purposes. Yep, cool. I think we've got one more. When you said that it's mandatory from 1 January 2024, the updated disclosures will take effect on December 23 or December 24. So mandatory 1 January 24 is accounting periods commencing on or after 1 January 2024. So the first year-end impacted will be December 24, being effectively 12 months after 1 January 24. So they don't take effect from, or it's not mandatory for December 23 balance dates. But again, you will require to have comparatives. Do you think I've made sense there, Garley, or do you want to help me?
No, I think you made sense. So it's mandatory to apply the amendments from 1 January 2024. Yeah, December 2024 year ends, and then say March 2025 year ends. Hopefully people were not confused by the reference to when we issued the standard. So we issued the standard in May this year, and for legal purposes, it became effective in June this year. But this is not when it's mandatory to apply. This is just when it, as a legislative instrument, takes effect.
Yeah. Yes, there's 3 dates, and there's an issue or publication date. There's when it takes legal effect as secondary legislation, and then there's the date, which is most important, when you've got a mandatory requirement to apply it. That's the date you have to start using it. Cool. Just checking time. Well, we've gone 2 minutes over. So that has been, we've addressed all the questions, which is brilliant. Myself and Gali and anyone at the XRB, we're available anytime for you to contact us when specific questions arise. We can't provide accounting advice, but we can definitely point you towards the right direction and let you know about a specific paragraph in the standard which might help you. But again, if you've got questions, that's really helpful, because if we need to, we will issue additional guidance on this to help promote the consistency. So we welcome your feedback as you start using this amending standard for the first time. So thanks very much for everyone's attention. Thank you for your questions, and I wish everyone a brilliant day. Thanks very much.